I'm Hilde Weber.
And I'm Evelyn Elliot.
Join us as we undertake a journey to find out everything you wanted to know about real estate in the greater Seattle area. You can defer the payment of capital gains through a 1031 tax exchange program. But how does the 1031 tax exchange program actually work? We decided to find out from attorney Richard Morse, a leading expert in Washington State.
Good morning, Rich. Thank you for joining us.
Well, it's wonderful to see you, Evelyn. Thank you very much.
We're going to ask you a few quick questions. What exactly is a 1031 tax exchange program?
Well, it's a means for an investor such as maybe yourself to preserve your capital and avoid paying the capital gains tax and move your equity, your capital, from one property to another property.
How does it work?
Well, it's really easy, ultimately. The way that you would do a tax-deferred exchange is you would retain someone like myself who's a qualified intermediary. And then essentially then you're really going to close your sale to your property. You're going to make a decision to sell your property and to your buyer, and then you're going to go find new property that you want to acquire, and you'll negotiate price and terms on that as you normally would do, and buy that property from that seller. And it's in the paperwork that you will sign at the escrow closings that will qualify the transaction as a 1031 exchange. So it's really simple. You sell like you normally would do, and you buy a property as you ordinarily would do, but because I'm in the game, we qualify and jump through the IRS's hoops.
When should someone defer the capital gains tax on a piece of property?
I think the answer is really simple. A person, you make business decisions, you don't let taxes run the show. So if you made a business decision you want to sell your property, and you've made a business decision you want to reinvest and buy some new property, and that your tax bill would be at least $10,000, I think that's a setting of where a 1031 could be beneficial for you.
Does the exchange only have to be for rental or raw land replacement, or can it be other types of property exchanges? Examples like a commercial building or a boat.
Well, the 1031 is for like-kind properties, and there's two categories of like-kind. There's real property, which is what you were primarily dealing with, and there's also trade business personal property, which would be like an airplane for an airplane, a commercial airline. The definition of like-kind there is really restricted. It has to be an airplane for an airplane. But in the real property exchanges, it's anything other than a primary or secondary residence for any other type of property that's other than a primary or secondary residence. So raw land for a retail strip, apartment building for a duplex, raw land for improved property for raw land, anything you want, so long as it's other than a primary or secondary residence.
How quickly do you have to identify and purchase the replacement property?
There are two time periods that you have to satisfy for a 1031 exchange. The first one is relatively easy to satisfy. It's 180 days, essentially 6 months that from the day you close. If you close today, tomorrow is the first day of that time period. You have to buy your properties within the 6 months. Also starting tomorrow is the 45-day period you have alluded to, and that means by the 45th day after you close, you have to have decided what properties, identified which properties you're interested in acquiring, and you could identify them during the 45 days and then actually take title during the remaining 180 days. So you get 45 days to decide what properties you may wish to acquire.
What happens if you don't find another property in your allotted time frame?
Well, sometimes people don't. They just can't find the suitable replacement property that satisfies their needs, and so their exchange is over.
Rich, does the capital gains tax eventually need to be paid?
The lovely answer is no. Often people will involve their estate planning into their real estate holdings, and the way I say no is that a person, if you died holding the property, then your heirs would get what's called a stepped-up basis in that property, and thus there would be no capital gains when they inherit your property. So you can literally beat the tax man in your grave.
Rich, thank you so much for your time today.
Well, it's been fun. Thank you very much.